Good morning, folks. Hope you're doing well. Waiting here, see if I can hear myself on the audio check. You're probably going to hear some landscapers outside. I was a little surprised to see them starting so early, so can't be avoided. Good morning, folks. Hope you're doing well. Waiting here, see if I can hear myself on the audio check. Obviously too long of a delay here. Hang on. Landscapers outside. Let's see if I can get this latency up. If I can change it, or I'm not sure I can do that once I start the stream, can I? Okay, well, we're going to have to call things way in advance then. So what we'll have to do is endure this one. It won't be all that time sensitive. But the comments section is usually littered with folks that are outside the English language, and they're looking for closed captions and subtitles. And if you use the lowest setting for latency on the live stream, every live streamer, or if you ever live streamed, or if you want to look it up and check it yourself, you'll see what I'm saying is true. It doesn't allow you to do subtitles. I guess because the latency is so low. So from the time I say something and time you receive it, it doesn't apparently have enough time to do what is required to get them supplied to it for the live stream. But given enough time, after a while, they get populated in the recordings. I don't try to hide the subtitles. I don't turn them off manually. Sometimes this platform just does what it wants to do, and it isn't always what we would like to see it do. So anyway, I had this live stream today set to normal latency, meaning that whatever the normal default setting would be normally, that's what it is. That means there's going to be a little bit longer of a delay, and it's okay. I promise it's not going to hurt you, and it'll still be pertinent. I can't edit it. Whatever I say is what I see or feel is important at the time. Majority of you are watching in the recording anyway, so the numbers have dropped off because they don't have the time to sit here because they're working, they're in college, or they're sleeping. So, and a lot of them are forex traders, so they're just really waiting for the little nuggets about what works here and in forex. So let me put my chart back up here. All right, so obviously I shared something with you this morning. I get a lot of questions, and I get a lot of students asking me things that, can I show how this would be done? How can I do this and how can I do that? Basically what I was doing with that TD Ameritrade account, and I was using a live account to do those types of things here. The question came up, what happens if you get into a trade and everything's working out well, but you haven't learned how to trail your stop loss like we were talking about yesterday, or you're growing into learning how to do that? Invariably, you're going to get stopped out. Sometimes I get stopped out prematurely and I'll have to go back into a trade. How do I do those things? How do I navigate that? Well, first there has to be some kind of a premise to it. And the idea is we have ran from yesterday. I promise we'll get through this part before the opening bell. Just relax. I've gotten better at this. I'll believe it when I see it. That's what my wife used to say when we were younger. I'll believe it when I see it. Well, there's stuff she still can't believe, and she sees it. All right, so here's the business. We opened at 6 p.m. yesterday evening with a huge gap. And if you grade this, okay, it's not quarters theory. Okay, so stop calling it quarterly theory or quarters theory. Okay, it's called grading an inefficiency or grading a price swing. And you learn more about that also in the core content lessons. You can find that on the 2017 mentorship and I think subsequent lessons and lectures I did. But you can do your fibs there, put the quadrants in it, and you'll see how it beautifully handles that here, quarterly, and then hits the top of it, rallies up, and that fair value gap that I outlined yesterday afternoon in the live session, extend that forward. Wouldn't you know it? Look at that. So we rallied up, and we have been basically just in a strong buy program. And then Tuesday's daily low. Isn't that ironic? Tuesday's daily low, when we were entering the time of day leading up to the morning session. And if you look at what we have here, we have a consolidation, relative equal lows. We rally up, accumulate, reaccumulate, smart money reversal. Why is that smart money reversal? It's turtle soup, relative equal highs. It pops through that. I was not able to secure an entry on that. I was watching YouTubers and I saw a YouTuber talk about what they feel the NASDAQ was going to do. And true to fashion, I had to be a contrarian and go in there and fade that individual. But I had to wait for the order block here, which is a small breaker in itself, but this is the larger one. I like that. That's why it's annotated that way. But that is the change in the state of delivery. It's this candle and this candle together makes up a bearish order block, but it's the opening price, the lowest of a consecutive number of up-close candles, the lowest open. That's the change in the state of delivery. Okay, so that way we're correcting individuals out there to miscalling things. Oops, I put this on. We only have a few minutes here to knock this out. Can he do it? All right, so this is what you see. All the business here. It's not market replay. Market replay doesn't let you see this stuff up here. So I'm going to take the labels off because you can see that in the recording now. And you can watch them up here when I put my cursor over top of it. So in this wick here, I'm buying it. I'm selling short as it goes back up into this area here. And I'm selling short again, adding more to it. And it breaks down for a small little sell side liquidity run. And then I'm using this as the breaker. I missed this open and run right back up into it. I would have been a better fill. So in the next candle, I had to get the closest thing I can do, which is that little volume imbalance right here. It drops down. Small little partial right there. And then I was watching this inversion fair value gap. This became an area to sell short in after being stopped out on the initial run. I brought the stop down aggressively, which would have never been done if you understand the market maker sell model. You got to allow that second stage of redistribution to start delivering. And it hadn't done that yet. So what happens if you don't know how to do that yet and you get stopped out? Well, we're trading back up into the inversion fair value gap. So I went short there after being stopped out there. Watch the recording. You'll see it. And then I was building in more here because I knew I was on side. I knew my market maker sell model. Breaks down, partial, and then below the original consolidation over here, you can see all the show off stuff that ICT likes to do. And then the balance, leaving it to be stopped out because I was making myself egg white breakfast, and it is what it is. And ultimately, where we're at now. So, ta-da! I did it with 30 seconds to spare. All right. So now we're going to watch and see what we get here. And it dug down into the Tuesday's old daily low. So that's the draw on liquidity with a market maker sell model. So we're blending things. It's not just relative equal highs and relative equal lows. We're looking for other things around it. Just like every up close candle is in a bearish order block, and just like every separation between two candles with one candle in the middle is not a fair value gap. All right, so here we are off to the races. Okay, so now we just go through the business of highlighting where we are in relationship to regular trading hours. So there's that. We have a really, really nice big premium. And it's going to take time for me to map all this up. All right, and then we'll go back to regular trading hours, or electronic trading hours, excuse me. So we have left this high, and we didn't get near it there. Okay, so it's still early in the game. No fair value gap is formed yet. So you have buy side up here. Well, the relative equal highs. Give it time to see if it wants to get animated and run above that. And here you go. So new day opening gap at August 27th. If it wants to really run itself out above here, it'd be reasonable to see it reach up into that. Wouldn't be out of the question. No fair value gap yet. No first presentation. Now this candle, if it doesn't go much further where it's at than it is now, I'd like to see it settle down a little bit. And this would be your first fair value gap, and that forms on the 931 candle. I'm also illustrating today that most of what you hear when I'm real animated and all, cussing like a sailor, that's me, like I said, being my character online. To prove it, you're going to hear me talk today with no issue reaching for those types of words. All right, so we reached to the new day opening gap high and through it. Now we have a small end dog here, reached there. And if you remember yesterday, I was referring to Antonio Trade's live stream, and my private mentorship students know this also. There's a huge pool of liquidity up here above that 694.75, isn't it? What is it? Let's get the original anchor point for it. It's over here. Right there. Okay, so it's that. So there's huge buy side up there at 694.25. I'm not making a hard case that it's going to go there, but you know, it certainly looks like it's trying to give the impression that it could do that. All right, so here's our first fair value gap. She is hot to trot today. Now, you might look at this and say, well, why don't you use this here? You can, but if I'm teaching principles, we want to try to use them as I'm teaching them. Like I was given an example for how to get back into a trade if you get stopped out, but not with a loss. You have a winning trade, you've had partials, you trailed the stop loss and it gets you stopped out, but you're not taking a loss on that. But then the trade's still viable. Well, I executed on it, and I'm giving you lecture notes today about how to do that. All right, so we're seeing potentially the first down close candle in this initial run here. But yes, you could take something like that. But I have a plethora of individuals saying, yeah, that's all impressive and all, but that's not the model. You don't even know what the model is, so stop trying to correct me. You don't know what you're talking about yet. I have to give you smaller lessons that build on the complete model, and that's how I'm teaching my son. So we still didn't get a down closed yet. So it's been just a straight run up right from Jump Street. So August 18th, new week opening gap. Traded to here. So since we've stretched out this far, I honestly would not be willing to see it come all the way back down here just to get to that if it's going to go up here. In this case, I'd like to see it just keep doing what it's doing here. Keep driving through and then get into this liquidity and then see if it can hold those levels. And if it can't, then this could be a draw on liquidity for the later portion of the AM session or going into the afternoon. That's how I use this information. I wouldn't be interested in trying to chase it because it's too far drawn out. And if you go back, I think 2 weeks ago on a Tuesday, I was mentioning how sometimes when the prices take off like this, it's okay. Just let it run. It'll come back to you for a low risk entry. Don't try to chase it. The first natural impulse is for you to think, well, I got to get on board. No, you don't. I mean, mass transit is a wonderful form of transportation for folks that don't have their own cars. Just because they're there and just because they're driving down the road doesn't mean you got to get out of your car to jump on that bus and take a ride. It doesn't make any sense. Just relax. And if you need a bus ride and you miss the bus at the stop, just wait 20 minutes. There'll be another one. Isn't that funny how that works out? Sounds like a macro. Oh, ICT. By the way, Daniel, thank you so much for the Yeti. It came in the mail yesterday. Please don't send me gifts, by the way. I'm not asking for it. So here's our first drop in here. Small little retracement into this inefficiency. I wouldn't touch it yet. Just want to sit still and relax. It would have been far much more fun if I could have seen on this candle or the very next candle, drop down into that gap or anything close in that proximity, because that would have been a wonderful setup for seeing things like a run, well, to these levels here, and maybe even get, if you can find the momentum to carry us up into it, really come all the way back up here and unset those individuals that have had their stops in those relative equal highs from yesterday. And when they had the fun of riding down post NVIDIA earnings, and then now here they're elevating again. Look at the bodies right there on the low of that new week opening gap low, and touching this old new day opening gap high on August 27th. So if it's going to run higher, I'd like to see it try to form some kind of a run off of this. Any more retracement makes it likely that we'll get down into this first presentation. And we'll have to see what we do should we get to that level. So this is a really nice opening range gap. Halfway is down here. I'm just going to change the color just to make sure I don't get lost in live commentary. Yesterday, you eagle-eyed students of mine noticed that when I was drawing out the first presentation, fair value gap, it had a volume imbalance in it. And if you have watched my live streams, where I usually edit that stuff out when I'm recording pre-recorded commentary or execution, whatever, the magnet setting I have when I'm moving things around, it's locked to strong, but not strongest. So that way, when I'm moving things around on the chart, it'll automatically snap to the open, high, lower, close of the candlestick. See what it just did? Just jumped. So because my prescription on my glasses are not updated yet, and I got to pick them up tomorrow morning, finally, the Ray-Ban frames, they'll be there tomorrow, but all my old glasses are there, so I just unlock them all at one time. Because my eyes are aging, and I'm doing this live when I'm doing it, I'm trying to talk about it, but you're smart enough to know that if you're going to highlight it, highlight that entire range. I don't draw this stuff on the chart when I'm actually trading myself. It's for me to teach it to you. But if it's below price and you're going up to that old premium rate, you're going to use the lowest low of it anyway, and you want the lower half. So it really wasn't going to change anything as it was described to you yesterday. All right, so first presentation, fair value gap. Watch that in here. Watch the wick. I like to see it go up and just try to go into the lower half of that, but not get past the midpoint of that, and then dig into that first presented fair value gap. So in other words, it's this level to that low. I like to see it just jump up there, keep that upper half of that wick open, and then trade into that. That'd be a nice little study here. May not even do that. Let me just get heavy and strap on me. Folks have been taking my videos from this mentorship and uploading them on my channel, and trying to run them without ads. As soon as you do that, I get notified from other people. They'll tell me they're there, or the copyright thing in YouTube server automatically picks up on my video. So I end up taking your videos down. You don't get permission to do that from me, so just don't do it, please. It's easy for me to just click a button and it's done. I'm not spending a whole lot of time doing it. It takes more time for you to put them up and have me take them down. It's funny how these old levels keep providing support, turning points. It gives you like a framework to judge. Okay, just about the low of that wick. Okay, I'm just going to use this new day opening gap low because it's kind of close to what would be the half of that wick. So what I was saying was I want to see if you can dig up into that, which essentially is already done here. It hit that, and then up to this point here. That would be the range at which I want to see, is there any sensitivity to send price lower? The initial run right off the open was just a straight shot higher, hitting the layered. I told you it'd be like a big black hole for price action. When these formed here on the 23rd of August, I mentioned that this is such a huge magnet on price. You'll see it used many times, and here it is again. It drew right up into it today, right off the opening. pool guys are here. The girls are barking out. That's why you're hearing all them crazy town barking down here. All right, so we dug a little bit deeper into that discount area, the wick on this candlestick here. Okay, so that would negate anything dropping down into a 15-second chart. That was on framing. If we were to start to sell off, working that lower half there, then we can drop into a 15-second chart and use a fair value gap to drop into this first presented fair value gap. That's how I was looking into it. It still could do it, but I would have preferred it stayed in that lower half. Remember, we're really, really elevated from the opening range gap low. So where we settled yesterday afternoon, we're really, really expensive. So it's important not to get so excited about, oh, I gotta catch this run. I've hurt myself so many times in my earlier part of my career, just chasing it, thinking, okay, it's gonna run. Sometimes it does. Sometimes it just takes off and it's it. You don't get a chance to see much of a retracement or a drop, and it leaves the opening range gap open for the day. Never even trades back to it, but eventually it does trade back to it, and it's more likely that we'll have a better discount into the marketplace. And certainly, before I would ever want to go long, I would want it to do that. I'm gonna put you on mute just for a second. Tell my wife to try to keep these dogs quiet. Lots of layered in here. And if we just drive through that aggressively, like if it's one or two candles that gets through that, that's really likely that they're trying to get it up to here. And it'll be really interesting to see how much of a drop off it causes once it gets into that liquidity above there. Should it do it? I'm not saying that, or making the hard sell that it's going to go there, but if it can slice through all these new day opening gaps and the new week opening gap, and if it does it in stunning, easy fashion, that means they're just really going to drive it up to here. And after having such a large gap opening, no retracement into the gap, just a steady run, getting up to this liquidity here, that'd be like puking it out, and then send us down into here, and then digging into the opening range gap. So this is far in advance, even with the natural normal latency. Should it trade up there, you have heard me say it before you're getting it live and comparing it with your live price action. And there's a little bit of a delay, but it's okay. It's not going to be earth shattering. See if we can pick up some accumulation here around the new week opening gap low into that buy side balance, sell side inefficiency. Isn't it crazy that one stock, just one, and that's enough to make every other company bend the knee? Like every other stock has to suffer or finds new love in it because of one stock, Nvidia. Come on now. And you think it's not rigged? It's ridiculous. What's Procter and Gamble and Caterpillar? Have to do with Nvidia? Nothing. But they'll all be moved around. You know, every other stock out there will be moved around. Like a paper company. What's a paper company going to have to do with Nvidia? It's a chip company, right? So if that is the case, and Nvidia is going to have that much influence, it just makes it easy for them to manipulate everybody with just the sentiment around one issue. You see how everything has been changed to this, that. In the old days, before electronic trading, it took real significant things for the market to maneuver and move around. And all the stocks would not move mark to market. It'd be a lag. It'd be like, oh, well, now we're going to start to roll over and go in sympathy. Now, because of electronic trading, it's easy for them to manipulate and control everything and everyone, and inspire or disrupt market sentiment. And all you have to do is use one or two stocks to do it. But there's no algorithm. There's no market makers. See that? They're bad words. So let's take a quick look at ES in comparison. S&T. Failure to make a higher high in ES, where we had that same comparable high at 936 to 949. 936, 949, higher high on NASDAQ, not seen in ES. So that is a indication. It doesn't mean there's a top. It doesn't mean it's time to see it reverse. It just means that we're waning in the likelihood of a continuation. If you then start seeing things technically break down, then you have the best of the best. So you're not just, SMT is a smart money technique or smart money tool. I never really settled on what the T was going to stand for, so I always interchangeably use it as such. So same element here. See that wick? So half of that wick right there. I'm watching that. Right there. Yesterday I had noticed that there was that package on the front by the door, and I said to my wife, I said, did you order something from Amazon? You got a package out there? She goes, no. I said, well, there's a package out there. She goes, what did you order? I said, I didn't order anything. And she looked at me like, really? Because I usually order a lot of stuff. And she walks out there and she grabs it and picks it up. And she goes, oh, did you get me a Stanley cup? I'm like, what? Did you get me a Stanley cup? You got me a Stanley cup. Smiling like she got it like it's her birthday. This woman has like 18 different whatever color Stanley cups are out, she has it. And she has the little bling things that go on the straw. She has like these little boot things, they call it, and these bows. Like, you thought she was dressing porcelain dolls like a little girl. She got so many of these stupid things. And she says, I'm going to sell them. People like them. What do you need the money for? And she ain't sold any of them. They're still sitting in there waiting to be used in the order she ordered them. But when she opened it up, she saw it was a Yeti. He looked at me, he's like, I can't believe you didn't buy me another Stanley cup. I said, I can't believe you think you need another one. What do you think this is, cologne? Only I can be obsessive about cologne. But everything else is Silly. You can't have more than one thing. That's not natural. All right, so we did not get a run into the half of that wick and start to roll over, and it would have afforded us an opportunity to go into the 15-second chart and capture any order flow that would send us into first presented fairway gap down here. So we're just sitting here and relaxing. We're not trying to predict anything. We're waiting for the market to actually indicate that it wants to move in a direction that's trustworthy. Here, it's too expensive. Anytime it's like this, I will elect to look for shorts over chasing it going long, because it's given every indication so far. I think we're going to run it. See that? See how fast he just ran out of in there? Watch up here. Well, 2 candles. We went right through all those new week levels and new day levels. 1, 2. So that opens the stage for a run up into here, because there's a lot of people up there that have their stops. Not your friend on social media, but there's a lot of people with deeper pockets than you and I. And their positions are holding larger volume. But as I was saying, in these conditions, like I mentioned I think it was 2 Tuesdays ago, where it just starts to take off running, if I'm not already positioned beforehand and holding on to something from pre-session, I'll just sit on my hands and relax. I don't feel any kind of nervousness. I don't feel any kind of embarrassment, a necessity for me to have to prove something. I'm teaching you what I actually do. Is I demand price come to me, and it has to behave a certain way for me to engage it. And when you know what you're looking for, you don't get all caught up in fear of missing out. And that's how you conquer FOMO. Is just you have to know what you're doing and be allowing the market, give it flexibility to do things without you. You give yourself permission not to trade every single fluctuation, and you also give the market permission to go and be a child, go run and play. I don't have to hold your hand every minute. That was actually a good analogy. Just I have to write that down. I may have to use that again for a future video. All right, let's see if we can spin our wheels here and run up in there and take that buy side out. I had a fella say very politely, I have a lot of respect for you and what you do, but I don't understand the way you act. You don't say what's going to happen beforehand in the live streams, but then when it does certain things, you'll say, see, it did what I thought. And I don't know what you're watching, but the things that we're looking for, the more pertinent things, I'm calling that stuff out. I'm also talking about what I don't want to see and what would be impediments to me actually engaging, what I want to see and what I'm not comfortable with at the time when it's presenting itself in the chart. And right on the heels of that comment, another person was like, can you just give me a short video of everything that you would say and do it in less than 30 minutes? How are you gonna learn how to trade? I mean, if you're going to trade, if you're going to trade, not just learn how to do something or watch something, because I'm convinced that these individuals just want to take the information and make courses with it or write books on Amazon. They want the cliff notes, and I'm teaching my son Caleb how to actually do it. So that means it's going to require proper understanding. So here's our return back into new week opening gap high, and now in this candle or the next, I would really want to see some kind of indication it's going to drive towards that 694 level. If it can reach up there, I would expect a really nice opportunity to sell off. But if you're learning how to trade, what is it you're thinking that's going to happen when you start trading? It's going to only work in 30-minute intervals and that's it? I mean, you got to be able to look at the entirety of the day. I'm only with you for a portion of the day, not even the full day. So you have to understand what you're doing, what you're looking for. Otherwise, you're gambling, right? Or you're not really looking at it with the full perspective, which is, in my opinion, what I'm trying to share. More appropriate way of deciphering what price is going to do. And you have a full comprehensive understanding. Okay, if it's good, it should start finding traction here and it'll run up there and bang that 694. Really, really expensive here today, right off the opening. Yeah, it never gets tiresome seeing, how the game of knocking the people out that have like the best positions that's been running, if they can go deep against them, like we're seeing here today, like that's it's always fascinating to me to see how far I'm willing they'll go to take that from them. And to read people say there's nobody out there trying to get your stops. Well, they're not trying to get your stops. They're going where the obvious largest pool of liquidity is going to be. And it's going to be what people have deeper pockets than you and I. All right, back down into new week opening gap high. Would you feel safe with your stop at 19,694? Even with that drop like that, would you feel safe with that? Could you sleep at night if that was the last thing you saw before you turn your charts off with your stop loss up there? Would you be able to go right to sleep with it? Lots of volatility here this morning. I'm using just the laptop, but I am peeking at the 15-second chart on my cell phone. That's why I'm quiet. I'm looking at it thinking, okay, so where is it at? There's a small little inefficiency towards the new week opening gap low still that it could come back into a little bit more on. question I have, if it's going to come that far up, right there, why would it leave a quadruple top at 694 when it knows there is a ton of orders resting above that? They're only a day old. They would have been carried from higher prices prior to yesterday, trailed down, and if they weren't, they were trailed down after we saw the drop down yesterday, overnight. So there's a huge pool of liquidity out there. Okay, new week opening gap low on 18th. Still nothing for me to do. Completely complacent. Not wanting to do nothing right here. How do you sit still and not worry about missing a move? Because I know I have lots of moves I can capture. I could disregard the entirety of the morning session and come back in the afternoon and do fine. At 2 o'clock to 3 o'clock, there's going to be a silver bullet. From 3 o'clock to 4 o'clock, there's going to be a silver bullet. There's 4 macros in the last hour I can participate in. So it's the comfort of knowing where the opportunities present themselves. But if something comes out the gate like this and just starts roaring, it's too rich, too expensive for me to want to buy it. Even though the last 2 days I've mentioned this area here is a really rich area of liquidity. It's not enough for me to buy it. I'm more comfortable with waiting to see, should we get there, do we break down, and it gives me something I can trade and go short with. And I'll be selling expensive things to market participants that want to chase and buy it. And it's usually when it breaks out up here, Johnny come lately, he'll be Johnny on the spot trying to buy something that's probably going to have a deeper retracement in the morning session. I could be wrong. It could go up there and blast off and go another 200-300 handles. Okay. I'm just saying rule-based ideas. I mean, you have to have a procedure, a process, and you have to be able to live with it. You can't just say, well, I'm just going to make it up on the fly. There has to be rules that you follow for engagement. And if you don't have them in advance, not something that you feel impulsively saying, well, I'm going to do this because I just think it's going to do this right now. What's the procedures that you've seen and studied by back testing and then forward testing, tape reading it, then demoing it for at least 3 to 6 months? That data, that's what you're going to lean on, not your natural impulses and tendencies to feel like, I got a hunch it might do this. You don't want to trust your gut, okay? Very, very pleased that I'm at a stage in my career where I can look back and see where I would have made terrible, terrible impulsive decisions. And now it's move slow when you're trying to make money. Move fast when you're trying to protect it. And that was a lecture note that I got from listening to Larry Williams. And he mentioned that in 2 of his presentations. One, he was a keynote speaker for short-term trading at a seminar. It was like a one event type thing. And he mentioned it there, which it really resonated with me. I was like, how do I apply that? Like, I have to know how to know when to sit still. When's it time for you to try to take a trade? And when is it not? Because saying the words and believing and agreeing with it is one thing, but having it so you can apply it is altogether something different. And it took years for me to figure that stuff out. And it's going to take you a long time too. It doesn't happen real fast, no matter who tells you what. The patience aspect and being able to filter ideas and trades, not being caught up in the momentum of things, it's hard. It's very, very difficult, especially if you're actively looking to see what other people have done so far in the day. So they may get very lucky and have captured something. That's wonderful. But what's the steady diet of their trading? Is it that type of reckless gambling? Because I'm not impressed by that. And you shouldn't aspire to have that for your trading either. So now we're back down below that old new week opening gap. Do we tag it, sell off, attack the sell side below here, and get into that first presented fair value gap? Then does it one more time press up into that 694 buy side? Or does it use the gap we're in here and just simply drive right back up and just do it? Because it's iffy, because it's 50-50, notice what I just did there? If I can frame it both directions, is it high probability? Not by my definitions. And compare and contrast that with, look at the setups I'm showing executions in. There's only one way to paint them. It's obvious it's going where I'm trading them. Here, I can paint it on both sides. And it's not something that I would feel comfortable putting money behind. So if it's something I'm not willing to put money behind, there's no sense of worrying about outlining it. You just simply study it, tape read it, watch it, with no weight on the outcome, because it wouldn't take anything from you, but it's just going to give you more insight and experience. In my mind, this would be like the last ditch attempt if it was going to go up there. If I was a bull, if I was a buyer, it would need to run from here and just be done with it. Simply because we traded outside of that new week opening gap, came back down into this inefficiency, which is part of a balanced price range. Down, up, singular candles, handle it, and we're here now. So it would need to start climbing higher here, or it's giving up the ghost and going right back down into first presentation here. And because either side can happen, that's low probability for me. It should be low probability for you. And that's not a time for you to try to trade it. You don't want to FAFO, as they say, because you'll probably get a result that you don't want. It's unfavorable. I'm going to mute this again just for a moment. You would need to find its legs here and run to that 694. or I would kill any interest if I was a buyer, if I was a bull. I'm not. But look how much time we've spent just meandering around. Yeah, there's been small little fluctuations in price. I'm not going to deny that. We can see it here. But is it something that I'd be wanting to engage on? No. If you look at the lows of all these candles, I like to look for areas where retail would see a diagonal support or resistance. And that looks like a prime candidate for their supposed diagonal support. So like a trend line, diagonal trend line. I don't use them, but I like to look for opportunities where I could fade them. You find that lesson in the 2017 core content, the mentorship playlist for the YouTube channel. It has that trendline phantoms. In other words, like trend lines that are fake and how to capitalize on them, what the target, how they're used. They're best used when our tools are suggesting it's going to be an easy run, lower or higher. And then when you see lines that could have been drawn underneath lows that are perfect or real close to perfect, that's what retail is looking for. They want that kind of thing. They're not looking at inefficiencies or liquidity. They're looking for connected dots. And connected dots is not what we do here. Banks and large institutions are not trading on connected dots type theory. There goes the trend line phantom I just mentioned. It's gave up the ghost. So now sell side's just in striking distance and in the first presentation. Fair value gap. So we were able to get down to the sell side here, minor sell side. It's an election year, and they are absolutely manipulating this market like crazy. I believe after November 6th, we're going to see some wild price action. And since the agenda will be behind that date, and you can read between the lines about what I mean by that, the market will be permitted to do things because we'll be under a different way of living. This is called that for now. I always thought I was doing a Twitter space. Do it, ICT. Put that tinfoil on, baby. All right, so we're looking at a breaker in here. I'm watching how we behave. this candlestick right here. That's the candlestick I'm looking at and where we're at in relationship to that. When it's like this and you have so many confliction references, things that could be this, could be that. When it's like that, you have to just simply accept the fact that it's not time for you to trade. It's simple as that. It's very simple. But it's very hard, especially if you're part of an online community or if you like to force yourself onto social media. You feel compelled, like you have to go out and prove that you saw something today and you did something today and you were right. And they're all part of the things we were talking about the other day that are their character flaws, their weaknesses, and you have to keep that stuff out of your trading, because if your results through the lens of other people's perspective about you is the goal, then making money ain't the goal. And if making money is not the goal, then your willingness to lose it on less favorable setups is there, and that's a problem. That means you're willing to do stuff that wouldn't be deemed high probability, but after it works, you'll go online and champion it like you had some esoteric knowledge or something superior, like the fellows that like to record and say, here's what ICT said. We walk when he talks. Do it live. Do it live and invite me. Don't mention me in your video. And that's the only thing you got going on. Do it live. I would have commented, but I don't want to bring too much attention to you because you ain't earned that yet. All right, so we've made things jagged on the upside after a premium opening. We've had 1, 2, 3 times lower. We're down here. We broke sell side, but it hasn't been convincing enough, and we haven't traded into this yet. So I want to see how we behave if we get into that. If it goes through it to the downside, I can see it be treated as an inversion fair value gap and go down to mid opening range gap. Now, Caleb would have already came to the conclusion that he can't take any trades today. It's already done too much. It changes to a improbable market condition for him. So he'd have to stay on the sidelines, turn his charts off, and he'd have to go back and look at what has happened after the fact later tonight. So he's not permitted based on what we've seen here. There's no setups he could have taken. First presentation hasn't even been traded to. So how's that losing money? It's not. How is it flawed logic? It's not. It's a criteria that he's being trained to use, and if you so choose to do it as well, it prevents you from being impulsive or chasing price action. It gives you a frame of mind that tells you you cannot or you can trade. If there are things that are going to be back and forth, 50-50, as soon as you arrive at that conclusion, just turn your charts off. You will save yourself so much heartache, so much drawdown, so many blown accounts and or lost challenges or funded accounts. You will lose so much money trying to trade and spend it in commission back and forth trading in these opportunities if you force yourself to do so. I know this because I've done it. many, many times. I had to restart an account so many times as a 20-year-old. I couldn't find myself out of the bad habit of just trying to impose my will on it. So you have to have procedures that tell you, yes, the framework in the marketplace is conducive for very low resistance liquidity runs. We don't have that here today. We have a big, nice opening gap, higher, wonderful. And then it starts right out the gate, straight up. Okay. With a failure to get to the liquidity that I was mentioning, and we didn't get there. So it could do it still, or it could leave it there. Which one are you going to go with? Whatever you say, and if it pans out, I'm telling you with 32 years of experience, you just gambled. Now, one can say, well, isn't that what trading is? Majority of everyone else out there, that's how they treat it, but they don't call it gambling. They may disagree with ICT, Poppy, ICT. That was some funny Instagram link. That was some funny. Someone sent me a link, said, you got a fan. Look, I don't even know who that person is, but it was funny listening to him. You made $500,000 in the last month? Well done. That is amazing. That's awesome. That is awesome. It's not even a quarterly payment in taxes, but it's still good. Nobody should be able to talk down against something like that. That's some good chops. Poppy ICT, I can't trade, bro says. That's some good stuff. Hmm. All right, so we got 3 more minutes. 10:30 comes. I'm going to close it unless it gives me something really, really earth-shattering. Poppy ICT. I'm going to have to put that in the list of names now. I have so many names, and how I love the old names. Oh, man. Okay, let's look at it this way. Let's play devil's advocate. Like that? Let's say that we did go down here and hit the stops. To me, this is a little too anemic. And it starts to run here. What happens if that's a breakaway gap? And then you have this gap here, we can trade down to institutional order flow entry drill. And then they run it from there to take the buy side at 694. Or, because I just outlined that, they just run it right on up there and there's no entry. And guess what that means? Sitting still was good. That's the right decision. That's not a regretful decision. It's not a, but I could have made money chasing it. That's you making compensation for lack of patience and not having the visibility of seeing that these things will repeat. And you don't have to have your setup just right now because you're sitting in front of the charts. You have to be permissible. Yeah, I'm sorry. You have to allow the market to give you things that are permissible in delivery. So that means you allow it to do it and have no influence over you by pressing a button. It's hard. I ain't gonna say it's easy. It wasn't for me. It was not easy for me. And because I'm a little bit more stubborn, it was a lot harder for me than probably will be for some of you. You might actually get through it a lot easier with structured guidance. So we're inside that fair value gap there now. Man, I don't know what's going on, but Deer Park used to actually taste pretty good. And this water is tasting like bath water. So I usually drink Evian, Fiji, and Deer Park is what I just grabbed to come up here. And it tastes gnarly. It doesn't taste good at all. So it's actually making me feel sick to my stomach. So what you would be looking at is how it managed to trade if it can get above this high. You're looking at these relative equal highs. Does it go through it and accelerate? And does it accelerate into the high of this candle? Because it's outside of the old new week opening gap high. So you're going to like measure the ability and strength and speed. If it can trade to those two levels, does it do it quickly? And once it gets there, does it maintain its bullish body and not create a wick and start to retrace back in? That's not what you want to see. You want to see how it behaves above this high, if it can rally there, and then you want to see it accelerate and break through the new week opening gap high and trade here. If you're long, if you're bullish, if you're looking for it to go up to that 694 buy side. That's up here, by the way, again. This week's lectures were all around contending with things that's going to be problematic for your trades, things that you're going to wrestle with. When should I move a stop? How should I move a stop? If I get stopped out, how do I go back in? Well, you got all that. And now when you have a market that's opened up strong, ran out right from the opening higher, but it hasn't given you any meaningful retracements where you can frame the risk based on what has been taught to you thus far, then you have to give yourself permission to sit still and be comfortable with that. Being still is a position that wins every single time. You never lose money sitting still. You never, ever, ever lose money sitting still and not entering a trade. Sidelines is it's always winning. Okay, so we have the run above that high here and that high. So these two highs have been taken out. Do we have the ability to use continuation to drive above this high? If it can expand above that, we have cleared again the new week opening gap, the new day opening gap, and the new day opening gap right here. That's usually, it's only 2 ticks. 1 tick is still a gap. If I were long from that fair value gap down here, as I outlined earlier, remember we were playing devil's advocate, I would demand that it literally sends it right now. Using institutional order flow entry drill for your entry on that candle there, you'd be in at 587.75 or maybe 588 even. So 588 even stop would have to be 589 cover costs and commissions. So that way if it comes back on you, you're stopped out and you didn't lose anything. You paid for your ride to see it. Okay, it wasn't a destination or a port of call. You sailed by. That way, if you get stopped out, you had a chance to ride around, but it didn't cost you anything. You got your money back. So, see what it just did there? That candle here, and we went above that new day opening gap, and then we went right back down. So that's not what you want to see. You don't want to see things like that. It doesn't mean you're stopped out yet. It just means that you want to see momentum drive higher. And it's normal for having one candlestick retracing like that, but it needs to quickly overcome it and break to a higher bullish candle. In other words, it's got to move outside this candlestick's range to the upside. It can't be spending time, marking time inside that range or going lower. That's not good. And when I used to do the paid mentorships, which I'm never going to do a paid mentorship again. So, and for the people that left a comment saying, you're a liar, you said you was never going to do a mentorship, and here you are. I never will do another paid mentorship. It's context is king. Okay, guys, you take things out of context and twist my words. So yes, I'm teaching my son, and he wanted to make it available to everybody. So here I am. But when I was doing that paid mentorship, I would do these live streams and I would talk about the market live over the price charts. And I would outline them and say, look, this is what you're looking for. We're studying price in high resistance liquidity run signatures and low resistance liquidity run signatures. And when it's low resistance, that means it's going to be real easy. The market trades around nice. It's easy. It's one-sided. You don't have conflicted analysis. It's just one-way streets to go to inefficiency or liquidity. And the only way you can identify that is by watching price action in both conditions and me outlining what they are at the time. So that way you can see it. It's like, oh, I understand what he means when it's high resistance. I understand what he means when it's low resistance. And having that framework given to you on a day-by-day basis, which is what mentorship was, it gives the students a baseline perspective on being able to gauge if this is a climate for them to go in and even expect to trade the form. That would be high probability. If you can develop the skill set to identify when the market's really prone to be adversarial on both sides for traders that go long and short. In other words, if it forces you to be absolutely 100% nimble and zero forgiveness for either side being wrong, that's a high probability that you're going to lose money that day. But because most individuals don't have that understanding, and most traders that have a mentor, their mentors don't know how to do that. They don't know how to frame a criteria that says this is high probability, or this is a climate that is not conducive for low resistance liquidity runs, where the market just trades real fast, just easy stuff, real easy, quick, sudden, immediate feedback that's positive. That's what I teach you if you've been paying attention. I'm teaching you by identifying when it's ugly, when it's harder for you, when it's going to be 50-50 trading, because I want you to feel what it's like to watch and see how hard it is for price to make its way through certain areas, and how it's very difficult for it to trade and gain ground or lose ground if you're bearish, and just stays in these ranges like this. Not that you can't, obviously you can trade it. I mean, right now, if you close the position where I was saying, let's play devil's advocate, and we use this fair value gap, well, you'd be long. If you closed it right now, what shape would you be in? About 50 candles or so. What's wrong with that? Nothing. Problem is, you're listening to me talk about clearing this high and getting up to here. And some of you will say, it either goes there or I won't get out at all, and it's going to have to stop me out. So it's a stop out or my target. And people that say that are stupid. They're stupid, because what you're saying to the audience members that are listening to you, wasting their time listening to you, listening to that logic, is the argument usually made is, well, if you open the trade up with XYZ measure or percentage of risk, why would I want to get out with less than what I opened it up with for my target? Here's a novelty for you. Making money, because partials are 100% profitable all the time. There's never been a partial profit that's ever lost money, ever. It's never happened. It's in its name, profit. Okay, so when you close it, you have gained more equity. It may not be the highest degree of profit that you had hoped for and aspired at the time when you first got to trade on. But you have to understand, as a trader, that you have to be dynamic and evolving continuously while price is moving and gyrating around. Because what might be visible in the charts when you first sit down to enter the trade, and it might make sense to put the trade on, it might have everything going for it technically, and then it fizzles out. It just falls apart. All the technicals just fade away. And you start realizing that maybe I'm not in a trade that is going to pan out for me. Well, as soon as you feel that as a developing trader, the first thing you want to do, cut the trade in half. If you have a profit, take it off, half of it, whatever it is. Well, it's only going to be $100 in my commission. Yep, sure is. But you know what it's going to do? It's going to reduce the anxiety about you feeling what you are observing, but you're arguing about it. It doesn't look like it's going to move. Man, should I get out? Should I not? Should I close it? What do I do? What do I do? As soon as you feel that, when you're learning and you're developing, whatever the trade size is, cut it in half. If it's only one contract because you can't trade with more, just close the trade and then tape read the rest of it, because you have to be able to remind yourself continuously that you're in control of your own actions. The broker, ICT, somebody on the internet, the market didn't suck you in without your permission. You pushed the button. You entered those orders in. You put yourself in the marketplace, and you have to find your way out of it, whether through blown account, through drawdown, or profitable trading. And the goal is profitable trading. And since it's understood that nobody walks out here on their first day knowing exactly what to do without making any mistakes, it's reasonable for you to say, I'm uncomfortable. And why put yourself through unnecessary hardship? You're going to feel the same angst about the trade not working for you if you close it and take half off, or close the entire position if you have just one contract. And then you have the protection of not losing money, not having realized drawdown in your paper trading account, your funded account challenge, or your funded paper trading account, because that's what they are. It's better for you to manage your emotions and the psychology around your actions or the decisions you're making. When you feel that pressure inside, trading through that full bore and just saying, I'm going to hold on to it, that has to be graduated too. And the way you get to that point is, in the beginning, you'll be anxious, okay? And then you'll close the position. And you're going to realize, for folks that are highly critical of themselves, when you're tape reading, that means you're not even demoing. When you're not even a demo trade, not even a paper trade's on. But you have convictions about why you think the market's going to go up or down from wherever you were watching it. And you'll feel anxious. And you're not even in a trade. And that is the surest indication that you're hypercritical of yourself. And chances are you probably beat yourself up. You probably have beat yourself up in your journal, if you even journaled. There's a lot of jokers out there that'll say, I ain't got time to journal. I'm a man. Every significant, wildly profitable CEO or owner of a business, you know what they do? They keep records in a journal. Yeah, that's what the rich people do. Bart Simpson doesn't keep a journal. We're not trying to be a Simpson, okay? We're trying to be a Samson, a conqueror. It would need to find legs here and reach up in that 694 if it was going to go at all. I got 90 seconds. I told you about 10:45. Now, earlier in the recording, I said yesterday, I said about 10:45. All right, so now what you'd be watching is how it behaves inside of this inefficiency. You do want to see if it can get above this SIBI. You want to see it get above the high of that, which is that level there, and expand with momentum and strength to drive into that high here and then attack that 694 buy side. Right now it's a quadruple high. This high, and then I'm not going to scroll away in case it runs up here because I want it to be on the live stream should it do so. But you want to screenshot this right here because this is a really good opportunity for you to see if you would have used the fair value gap we gave as a devil's advocate exercise. We're saying, let's say you wanted to be a buyer using this fair value gap. Should it trade down into that, which it did, and then rallied up? Here is the first target for partials from me. That would be my first partial because it's too close to everything else down here to warrant taking a partial off. Here, it's really close to that high, and it could fail. It doesn't mean it's going to go up here. It could stop right where it's at and go lower. But the way you have to learn how to trade it and engage it is we're in a real rich premium at the high end of that SIBI, this fair value gap with a down close. SIBIs are always down close fair value gaps. So hitting that and taking a screenshot of that and then annotating how much time it took to get to that candle, touching this candle's low, from the low of this candle, which is institutional order flow entry trail. So when you screenshot that kind of stuff, when you're watching price action or when you're watching me call like I'm doing here, compare what I just outlined here using this fair value gap and then saying that would be my first partial. Then look at the trades that I take and how I execute. I'm getting in on down close candles right at the lowest candle, and then it rallies up and I'm getting out at short-term highs. Look what it's doing here. Look at the behavior there. Even if it turns around and rips, goes up here, that right there is enough to warrant the logic I'm sharing. It's giving you bookends, okay? A beginning and an end. Where something should start and where first partial is. Now, if you rolled your stop to, say you give yourself a pizza dinner and commissions cost covered, what is that for you? I don't know. Say $100, $200, and just let the trade go. You've paid yourself. You've executed rather handsomely with very, very good precision, getting out at a short-term high that formed at a logical level where there's a premium level. Do you need me to push a button? Because I outlined it for you right here. But some of you want it because you want to copy me. And I'm trying to keep you from needing that right now, because I will be pushing the button in front of you. But I want you to understand that it's going to take a great deal of control for you to not want to push the button when I do. I'm going to put limit orders in the marketplace. So you'll see those orders resting there, and price will come to the limit order and it'll fill me. And whatever happens after that is what we'll watch. But I want you to have the maturity to say, you know what? I'm going to just simply study this, and I'm going to exercise discipline over myself. I'm not going to be impulsive. I'm not going to be greedy. I'm not going to fear missing something, because what I'm learning how to do this on my own. I don't need to copycat Michael. That's how you graduate this mentorship. Okay, the last 2 weeks that we spend, I'm literally going to just be doing entries in management. That's what I'm going to be doing. And once I'm done with them, I don't want to see you tell me, thank you, I made this much money, or I passed, because that's literally the surest way that I'm going to block you from ever being able to send me a comment. And you might not care about it, okay? But I don't want you doing anything to copy me, because I know if I'm doing it here live, you're going to be trying to do it with real money, or the chance of you losing something you paid for, like for a funded account company, Challenger or whatever. And I don't want you in my trade, because then it's not my trade. It's me managing the outcome for you. And I don't want that. I'm not trading other people's money. OPM is not me. That's not me, baby. My name's ICT, not OPM. Other people's money, in case you didn't pick up on that. You down with OPP? Yeah, you know me. Yeah, you remember that? Still no cuss words. How about that? Told you, folks, it's just a character. Just a character. It gets people talking about me, and it brings them to the channel. That's what a master of marketing does. No advertising required. Just manipulate the audience. Get them talking. All right, so now we're at the consequent question of that premium wick. See, every single time it jumped. So we are just hitting it right there. What's the price? Consequent quotient, 694.5. The high, oh, it went one tick above it. So there you go. Now we're definitely above it. So we would demand that it really accelerates and just does it in short fashion, because they don't want them to take those orders out of the marketplace. So the framework looks like this. I told you these lectures this week are going to be the dry ones, the boring ones. But I promise you, after doing this for 32 years, I literally would have paid everything that I would be willing to put into a trading account back in the 90s when I was learning how to do all this stuff. I would have I would have paid gladly for this information. With someone sitting out here explaining the logic, proving it to you where it's going to go and how to be a master of yourself, and don't try to demand that you know what you have to do right now all the time. And I'm teaching because my audience member is my son, and he doesn't have the ability yet, but he's going to have the natural tendencies to want to impress dad. He's going to have the natural tendencies to look at the last time he got it right and think, I want to do it with real money sooner than I should, or I want to trade more contracts than dad told me to do, or I want to get in earlier because I don't have the patience to sit there and wait for the setup. All those things that you've been wrestling with, and I wrestled with too, and every other trader does too, I'm trying to spare him that. So that's why I'm teaching this way, because I want him to be bored with the delivery of price, what we're looking for, how it should behave. All those things should be building blocks for you, Caleb, to wrestle your impulsive nature, to wrestle fear and greed, not fall victim to fear of missing out, and feel uncomfortable just letting price move and finding your model, and also being comfortable with what you're expecting to see in price action. And if it's not being delivered to you, sit still. I mean, let's say you went to a 5-star restaurant, okay, you couldn't wait to get there. You've been waiting all week, you worked all week, you put some money aside, you and your significant other, you're going to this 5-star restaurant, and you get there because you want to have lobster. You want to have a stuffed lobster tail and all the fixings on the side that you usually eat with it. And you get there, and the waiter says, unfortunately, tonight, you're going to have to do something different. We're out of lobster. Well, all right, man. Give me the BLT. That's what people do when they're watching the marketplace. They can have a model. They know what they're looking for. The menu that they want to eat off of is filet mignon and lobster. But when they sit down in front of the charts and they start watching these things dance around on their screen, you know what? Grilled cheese ain't that bad. Peanut butter jelly? Yeah, fold me over one piece of bread. I mean, I got the heel. I got the last piece of bread. I got to eat. I got to eat, man. I got to eat. I got to do something. I've been sitting here for 2 hours. I got to do something. Instead of demanding the waiter find some lobster or we're going to go somewhere else. And somebody that has money, we don't look at it as I'm wasting gas because I'm going to have to find somewhere else to go. I'm going to leave. If I went to that restaurant expecting what I'm wanting to eat, like for instance, I like Ruth Chris. I like the one on Water Street down in the harbor, and their crab cake is phenomenal. And if you've never had a crab cake done Ruth Chris style, it's the Chesapeake Bay edition of it. It's the only one of all the Ruth Chris locations that has been given permission by Ruth to do that blend. To get that crab cake, you got to come here to Baltimore. And I promise you, if you get it, it will dance on your taste buds. It is absolutely amazing. It's so good. I can't eat a crab cake unless it comes from Ruth Chris. And I'm a Maryland boy. I like crabs to an extent, and it's got to be in a setting. Usually when my daughter visits us, like she just went home, we take her out to get crabs, and we had crabs twice while she was here. And if I don't eat a crab the rest of this year, I'm okay. But if my wife says, I'm in the mood for a nice steak, well, she eats the filet mignon. Ruth makes an amazing steak. It comes out 500 degrees sizzling on a plate. You hear your steak coming. It's sizzling as it's coming to your table. But their crab cake's better. That crab cake is such an amazing, it's so good. It's perfectly seasoned. It's so good. So, Ruth Chris, send the check in the mail, please. This video does not have paid sponsors. It's just me saying who I like and what I like. You're never gonna see no affiliate with me, okay? I don't get paid advertisers in there. I get them all the time offering me stuff, but it's never been something I'm gonna reach for, despite how rich some of those offers have been. All right, come on, get up there and be done with it. I'm over my schedule a lot of time here. We're ICT overtime. So I was watching this breaker here, and all of my PD arrays all have inversion aspects to it. And as a reminder for the folks that are running around saying, yeah, it's 81 PD arrays, but half of them are just going bullish or going bearish off of them. No, there's individual PD arrays, and they themselves have inversion aspects to them. So it's double the 81. But this breaker, we went above it, and then what were we doing at the top of it? Accumulating. Fair value bet created. I mentioned down here, I said you would treat this if you were bullish. Go back and listen to the stream. If you were bullish, this could be viewed as a breakaway gap, and then this could be a institutional order for entry drill, meaning what? No full closure of the gap. Well, let's test that theory, ICT. There's the high. Oh, maybe you shouldn't see it. There's a candle high, and that candle's low. Trades into it, but leaves it open. There you go, institutional order for entry drill. For the folks that are screaming at the computer screen, dude, where would the stop be at on this? Well, what have I taught you so far? If this is your first time watching, then you're allowed to not know that. But if you've been with me and I've taught Fair Value Gets in other lectures before, and you also watch me execute too, this candlestick is your imbalance. That right there is where your stop loss is, -1 tick. If you want to be conservative, you use the first candle's low, -1 tick. But I like to keep risk manageable. So the imbalance candle, if it's a buy side imbalance, sell side efficiency, or an up close fair value gap like we have here, my stop would be right below there. So by contrast, you would see a fill at 87, or we'll just use 88. Okay, we'll fluff it up and use 2 ticks above the low of that candle. So you have 88, and the low of that candle 70.5. So you have 18 handles. So you're already doing the math on that, thinking, wait a minute, now I can't do 15 contracts with my Top Step account. Well, that's a good thing. That's a good thing. You need somebody to remind you to stop over leveraging. Stop making these people money. You're supposed to be making the money. And the way you make money is you control risk. But what happens if you were trading 5 micro lots there? 5 micro lots, and you get 100 handle run. We'll just call it filled with slippage and costs with commission. Say you got in at 90, that's your average price with commission costs. And you trade all the way up here, and you're getting right here or your first partial here. So you got anywhere between 60 to 100 handles, risking 18. So the best case scenario there is you have a 5-to-1 gearing. That means you're risking $1 to make 5. That's your math on that. That's good. If you trade like that, and that's what you're setting yourself up for, those framework type trades, you can take losing trades and not be perfect. And you could lose half the time and still be profitable. You can lose 30, if I'm not mistaken, I think it's 38% of the time, only being correct. So being incorrect more than 70% of the time, losing more than 70% of the time with this kind of gearing, you can still make money. How's that possible? Because every time you win, you're getting 5 times what you risk. But as you're trading, as the trade starts to move in your favor, you want to reduce that risk of whatever that $1 risk to make one $5 win. So your gearing or risk to reward is 1 to 5. Or said it this way, reward to risk is 5 to 1, or risk to reward 1 to 5. You're trying to make $5 and only risk 1. So that's your gearing. You can afford to be wrong a lot. And if you move your stop loss as the position moves in your favor, and you're trying to get to first partial, whatever your first partial is, whatever you arrived at in your trade, before you even put a trade on, you should know where your first partial is. And when the trade moves halfway to that first partial, if you move your stop to cover costs, that means your commission costs are covered. Obviously you're break even, but when people put their stop to break even, they're not break even. You're paying commission. So you have to figure out what your commission costs are on that trade and then move it to that and cover it. And if it allows you, go half a handle. It's $10. It pays for a pizza from carryout. Go to Papa John's, you can get yourself a one topping pizza. Tom ICT sent you. But you've completely removed any chance of it, unless it's a big crazy geopolitical event that you didn't see coming. Nobody can see coming, and it gaps away from you and runs over top of you. Then that stop losses in that instance doesn't work. You're going to get slipped bad. But you can be wrong a lot if you have 5 to 1 gearing in your trades, and you manage your stop loss like that. Whatever your first partial is, when it trades in your favor, profiting without taking any partial yet, as soon as it goes to 50% of that run or whatever, say it's 40 handles, that's your first partial. Once you get 20 handles in profit, cover your costs with your stop loss and just sit still. Now you're thinking, oh, I don't want to do that because what if it comes back and stops me out? It's going to show you that you don't know how to put a stop loss on, or you entered at the wrong location. And that's an opportunity for you to improve on. How's that for a novelty idea? How's that for logic? How about highlighting what you need work on so you can polish yourself and refine yourself instead of pretending you're going to walk through this without having any adversities or never doing it wrong? This week, I have been focusing on things that are going to be paramount to you encountering with the right mindset or not falling victim to this stuff because you're changing the way you think. And that's the better way of doing it. And I'm hoping that you're listening, Caleb, for that reason, because learning from it like I had to learn from it, you don't want those lessons because it brings scar tissue. You don't need to go through that stuff. You'll be better than I am because you don't get that pain, that regret, and it was harder than it needed to be because I didn't want to listen. I didn't want to be patient. And a lot of you watching, like today's session, it was probably very painful for some of you, and you're coming back now just to listen to the last part on twice the speed just to get through it, gagging at the dryness of it all. But what do you think trading's going to be like when you get into a day where it just isn't moving like you want it to? You're going to be thinking about all these things I'm talking about this week. And what logic do you have to lean on? None. You won't have any logic to lean on if you haven't listened and taken notes. You're going to listen to your impulsive nature. You're going to listen to your emotions that are always going to lie to you. You're going to be scared when you shouldn't be, and you're going to be overconfident when you should be fearful. It's like a paradox. You feel like you want to chase price and you have no fear. Think about it. Every single time you've traded, you have chased when price has been going up. I'm going to buy it now. It's been going up. I've got confirmation. Fearless. No concern for how much it could very easily retrace against you when you're not using a stop loss. You're brave in your ignorance of not using a stop. Wow, look at him. He went out there and bought that thing after it's rallied 87 handles. Only 2 down closed candles in the last series of up closed candles. Now he's buying it. Top tick Tommy. No stop. Full margin. All in. Contrast that mindset with waiting until your setup is in a discount when you want to buy. Wait for a shift in market structure. Wait for that first fair value gap. the form and have your limit order sitting in that fair value gap and wait for price to drop down into it. You're buying when price is moving away. That's courage. Most people don't want to do that. How do you know ICT is going to go into that fair value gap and not go below it? Because I've watched thousands and thousands and thousands and thousands of hours of tape reading, paper trading it, demo trading it, making real money with it, making your annual salary with it. And over time, it does what? It gives you confidence that what you're doing tends to repeat. And because you've been doing that, and you're also working in market structures, it's a little bit more challenging. Somehow, you know, the idea of being a mentor, these guys that are pretending to be mentors, they'll say things that never indicate that they have a period of when it's not easy for them. This is all my stuff. And sometimes it's going to be a hard read, or it's not a market condition that I want to operate and engage in. That's not insecurity. That is not insecurity. That's me knowing exactly what I'm looking for. I outlined this one for you. That's your silver bullet. Some of you completely forgot about it because we're learning new stuff. Isn't that the silver bullet? It's inside the 10 o'clock hour. Reaching for what? Old high. Every premium array going up. We got to cut through all this stuff here. All these layered new day opening gap and new week opening gap. That's what's causing, listen folks, this is the last note for today. When you're trading with high resistance liquidity runs, you're going to have this effect in price action, but you're not seeing it. That's why it's holding price back instead of having just a real quick one run through it. It's no problem. That's why I was telling you earlier, if it runs through it with one or two candles, which it did here, it should have no problem reaching up there. And it got real close to it, didn't it? And then petered out. And then we got real close to it here. And then petered out. But you don't need, I didn't need to be right about that because I gave you, watch how it performs above this candle here. Watch how it performs above here when it did this. We want to see it get above there. It does. We want to see it press through it. Why? Because we don't want to see it being held up like a cobweb, tangled up around its legs and can't run because of all the new week opening gap and new day opening gap levels in here. That's what causes the high resistance liquidity run market conditions. When you see these things layered up around each other, but you're not plotting them on your chart. That's why you've never noticed them. It's not an absence of buying and selling pressure. It's the fact that the algorithm has all of these levels it's paying off of. It's constantly offering this back and forth, back and forth, back and forth. Then it moves out of it, gravitates to the high of this inefficiency I told you. That would be first partial. I told you to screenshot that. And then I told you consequent encroachment of that wick. That's a screenshot. And if we ever get up here today, if you see it on your chart, screenshot that. And then backtrack all through this, how price maneuvered and behaved. If you rolled your stop here from entry to give yourself $100, a pizza dinner, date night, commission cost, and pizza paid for, Netflix and chill, were you ever in a position where you're going to feel in jeopardy? No. You funded the trade, we're saying it hypothetically, with first partial there. And then you take a second partial there if you can afford to do so. You're not jamming your stop loss up there because this is what you're going to get stopped out. So partials scratch that itch about moving stop losses. You compensate the fear and the trepidation you feel about being in the trade because you want to lock in something. The easiest way to lock in something is to take a partial profit at the highs as they form. When price is trading into these PD arrays that are premium levels, what makes it premium? Because you're entering here and it's been moving higher. So you're looking at all of this range from this high down to that low. Have you heard one cuss word yet? It's just a caricature, folks. It's just a caricature. I want to remind you that because some of you act like I'm literally insane. I'm not. I do it to entertain because it makes it memorable. And whether you like me or not, you start talking about me. And when you talk about me, other people are like, what's he talking about? Where did he say that? And then all of a sudden you get stuck in my web here and you end up learning what really works in the marketplace. When we ran above this high here, we had it, but it came right back in and was being held stagnant in between all the new week opening, new day opening gaps. See that? See how it's holding it down like a web, like a fly. Okay, imagine the price is a fly, and these are spider webs. Price is getting tangled up in it. And a strong fly that's in a web where the spider's out doing something else, it's not in its web. That never happens. I got webs in my backyard on our iron fence, and many times those spiders are not there until dusk, and they're sitting there waiting for lunch to come in and get tangled up. But a strong fly can find its way out of a web. I've watched it happen as a kid. I've watched it happen living where I'm at now, and that's what happens here. It just gets out of the web and runs. Where's it going to go? Where the sugar is, baby. Where's the sugar at? Up here. But it's getting swatted at. Okay, there's a fly swatter here. No, you can't get in there. Just like when it's trying to eat your barbecue spare ribs, your chicken wings, you're at your cookout. That same silly fly that was trying to get on my crabs the other day when I was eating them. It was driving me nuts. So I took a piece of crab, pinched it up, and put it inside the crab shell, the hood of the crab. And I told my wife, stop swatting at it, because when you swat at it, it gets over here and tries to get on me. And I don't want it crawling on me. So I said, let's watch. I want it to land on the hood of that crab. I put crab meat in there. I want it to go there. And it did. And it sat there and ate. So I was letting it have dinner with us so it couldn't crawl over me. So that's a tip for you. If you got a cookout, give yourself a little piece of meat or something, hamburger, pinch it up, break it up real small, and lay it down on a paper plate next to you. Their eyes are going to see the paper plate because they know that you're eating off of a paper plate. And they'll land on that food. And as long as you don't disturb them, they'll eat to their full, and then they won't be bothering you anymore. Didn't think that you'd ever learn that stuff from an ICT webinar. No cuss words. Man, what's going on here? All right, so I'm going to leave you with this. Watch this inefficiency here. We have essentially institutional order flow entry here. So if it's good, if it's really wanting to go up there, I would give it this opportunity here. Otherwise, it's probably going to bang around and spend more time in all this mess here. And I would not be wanting to trade that. I would be going doing something else. Go swim, go get a cookout without flies, and or get yourself some crabs. I'll see you all tomorrow, Lord willing, right before the opening bell. I don't know exactly when it's going to be, but sometime right before opening bell, we'll be back at it again. Hope you found this insightful today, and enjoy yourself, relax, and until I'll talk to you tomorrow. Be safe.